Why is it so hard to get capital to small businesses in low-income communities? Policymakers and philanthropists have prioritized getting more capital to low-income neighborhoods and entrepreneurs of color in the wake of racial justice protests and the ongoing pandemic. It seems like a straightforward way to address systemic racism and wealth inequality, but it's harder than you might think. Here's why. Entrepreneurs of color have fewer assets to back loans and less wealth to invest when they start a business. It's one of the long-term consequences of systemic racism and wealth inequality. For similar reasons, they often have lower credit scores and can't borrow from friends and family who face the same challenges. So when these entrepreneurs start businesses, they have to start very small. And when they seek credit to grow, their cash flows only enable them to repay smaller loans. According to data compiled by the Fed, 76% of Black business owners apply for small business loans of less than $100,000. They're also far more likely than white business owners to apply for loans of $25,000 or less. That's a problem because few banks are interested in making small business loans under $100,000. Virtually none will make loans of less than $50,000. Why? Because the costs of making a loan don't change much based on its size. To illustrate, a $10,000 loan with an interest rate of 10% yields about $900 in revenue to the lender over a one-year term. But even the most streamlined and efficient lenders say it costs at least $1,500 to underwrite and service that loan. Whether it's $10,000 or $100,000, the lender needs to do the same work to understand if the business is able to repay. That means that the lender of that $10,000 loan loses at least $600. The losses grow if the loans get any smaller. No wonder a recent study by the Woodstock Institute found that the volume of loans of less than $100,000 issued to entrepreneurs in low-income communities was 58% lower in 2015 than in 2007. Based on that math, you may be surprised that anyone makes such loans at all. In fact, there are two groups of lenders that specialize in serving entrepreneurs of color in low-income neighborhoods. High-cost lenders that often charge upwards of 50% APR, and Community Development Financial Institution, CDFI, microlenders. It's obvious how the high-cost lenders do it. They charge rates and fees high enough to turn a profit. Entrepreneurs that need financing go to them because they can't get it anywhere else, which of course further entrenches income and wealth gaps. How do CDFI microlenders do it? They have to raise grant funding to cover the gap between what they can earn on a loan with an affordable interest rate and what it actually costs to make that loan. They do an incredible job. CDFI microlenders who work with the Aspen Institute's Microfinance Impact Collaborative issued more than 8,300 loans, averaging $21,150 in a single 12-month period. 3/4 of these loans were to entrepreneurs of color. But there is a limit to how much lending they can do. It depends on how much grant capital they can raise to cover the true costs of loans that build wealth in low-income communities. If you want to get more capital to entrepreneurs of color who create opportunities, you have to support CDFI microlenders. These institutions know how to reach and how to serve the entrepreneurs and are committed to making the kinds of loans they need. Support isn't just about providing capital so these CDFIs can lend. It means funding the full cost of making small loans. To learn more, visit the Aspen Institute Business Ownership Initiative to discover ways to have a positive impact on low-income communities of color through entrepreneurship.